My name is Dr. Clement Obani. I welcome you to this lecture of GPTS ISQ. Today, we are presenting lecture on advanced accounting theory and business policy. Advanced accounting theory and business policy. So we know that accounting is based on the foundation of identifying financial transaction, analysis, recording, and summarizing this recorded financial transaction, then communicating those summaries into financial statements and interpretation. All these are done for decision making. The practice of accounting is based on certain theory or assumptions. The practice of accounting is based on certain theories and assumptions. Those theories and assumptions is what makes accounting to be a profession. Those theories guide us in the methodologies, guide us in our research in accounting, guide us in our application, and they guide us in determining what accounting statements are supposed to be. So we shall be looking at some of these theories because at master degree level, you are supposed to have an in-depth understanding of these theories so that they are to guide you in decision making and also in giving your clients, in giving your organization the proper accounting framework to guide them in decision making. So we will be looking at those accounting theories. So first and foremost, what do we use those theories to do? What are we using those theories to do? It is important at this level of your academic pursuit, you understand what we use accounting theories to do. One is that we use accounting theory to provide us with a general frame of science by which accounting practice can be evaluated. The first reason why we need the theory is that theory provides us the framework of science by which accounting practice can be evaluated. Another thing is that theory enhances our current understanding and practices to guide us to new practices. This theory gives us an opportunity to understand the current practices and it guides us in future practices. Then number 3 is that this theory helps us to eliminate unnecessary diversity. Because if everybody practicing accounting is supposed to come up with his own way of doing it, then that uniformity won't be there. And if that uniformity is not there, it will be difficult. It will be extremely difficult for for a statement of account that is prepared by an accountant to be interpreted by another accountant. So, like I said, this theory is what really makes accounting to be a profession. You prepare accounting, an account statement in Saudi Arabia, in Russia, in Australia, in Canada, in US, in Brazil, in Nigeria. Everything is the same because it is the same theory that guides the practice of accounting. So the last thing that this theory does for us is that it helps us to solve new problems, new challenges. As the society is getting complex, as organizational problems are changing, so these accounting theories help us to to understand these complex situations and also to predict how those variables are going to interact and the outcome of their interaction. And it helps us to guide us, recommend ways that we can handle these challenges. So in summary, we say that this accounting theory, it provides a general framework of science for the practice of accounting. Two, it helps us to understand current practices and guide us into new practices. It helps us to eliminate unnecessary diversity and help us to solve accounting problems. So now we are looking at those theories and how did they actually come about. Most of these theories come from what we refer to as the generally accepted accounting principles, the GAAP, the generally accepted accounting principles. These principles, we say they are generally accepted because in the practice of accounting worldwide, they are accepted as basic principles. Also, this accounting theory, some of them come from the Financial Accounting Standard Board. At the international level, we have the Financial Accounting Standard Board. In Nigeria, we have the Nigeria Accounting Standard Board. So they guide the practice of accounting. They recommend how accounting practice is supposed to be, and they tell us whatever be their instruction, whatever be the principle they give to us, we now apply it. So majorly, these theories come from GAAP, the generally accepted accounting principles, and also from the Financial Accounting Standard Board. So we shall be looking at some of these accounting concepts and conversion. We say accounting concept and conversion. Accounting concepts are rules. They are principles that must be obeyed. They are like law. You have to obey them without any variation. You have to obey them without bringing in your initiative. You must follow this concept if you want your final account, if you want your accounting statement to be recognized. But the conversions are general practices that have been done over time, which they are not written, but because most accountants uses them, that is why people now look at them to be what are general standards to be followed. But the one that is of utmost importance, which we must comply with, is the concepts. So we will be looking at this concept. The first concept that we shall be looking at is the concept, the entity concept. What is entity concept in accounting? Accounting is concerned with different companies, different individuals are regarded as entities. So different businesses are regarded as entities. If you are preparing the account of JPTS, for example, what happened in Lagos State University, LASUN, cannot come into the account of JPTS. It is only the account of financial transaction in JPTS that should be in JPTS account. If you are preparing the account of Unilever BSc, what happened in Nesto cannot be in Unilever BSc. That is, if Unilever pay their workers, now it will be the wages and salaries of Unilever. But if Nesto pay their workers, it cannot be in the account of Unilever. So we treat each individual, each business to be a single entity. We also have the going concern. Going concern means that accounting regards businesses to be operating on a present continuous term. That is, we believe that a business will operate till eternity. A business will continue to exist. A business will continue to grow. Unlike project, in a project, it has a definite starting period and a definite completion period. But in a business, we believe that it will continue to exist. That is why in accounting, we have carried forward and we also have brought forward because we believe that the company will continue to exist. Then the next is the historical cost. Historical cost means that concept means that accountants record the cost of assets. We record the cost of our transaction based on the historical cost. It is the cost at which they were bought. That is what will be in our record. Supposing somebody bought a land, that land was 100,000. Maybe after 5 years, that land is now worth 1 million. Though it is known the current market price is 1 million, but the market price when that land was purchased was 100,000. So in the books of account of the company, it will always remain 100,000, irrespective of the current market price. That is what the historical cost is talking about. So with this, if you are looking at the balance sheet of a company, you will see some asset. They said they cost so and so. This is the total value of the asset. That total value of the asset does not reflect the market price. Rather, it is reflecting the historical cost, the historical price, not the current market price. Also, we have accounting period. In preparation of our account, we have periodicity concept. This periodicity concept means that it starts from at the beginning of the year, it ends at the end of the year. Especially in preparing our trading profit and loss account, is normally we are looking at how the company traded, how the company fared, how the company was operated within an accounting period of 1 year. It could be beginning of the year, 1st of January to 31st of December. It could be on the 1st of April to 31st of March. Then we also have what we call the duality concept. Duality, it means twofold. Duality means twofold. In accounting, apart from accounting, accounting is the only profession that anything you are recording, you are expected to record it in 2 books. You are expected to record it, there must be double recording. First of all, you will record it in one book as debit, you will record it in another book as a credit. For example, if a company purchased goods for sale, maybe you bought those goods with cash. What will happen now is that in the cash book, money has gone out. You go to the cash book, you credit cash. So you credit that amount in the cash book. Then you go to purchases ledger, you debit purchases. So with that, the cash book is a book on its own. The purchase ledger is a book of its own. So this duality concept help us to now, at the end of maybe the month, you can decide to prepare a trial balance, which shows that the total ledger balances and the total ledger balances, credit side and the debit side. If all of them are balanced, we know that your double entry system is also balanced. That means you have used your double entry properly. Then we also have the matching concept. The matching concept. The matching concept in accounting means that when you are talking about revenue generated in a business or in a project, you must match it with the expenses made at that same time. So if supposing you are telling us this was how much was generated in a school in 2024, you must also match it with the expenses that school incurred in 2024. The expenses they incur in 2025 will not come into the 2024. So if you say we generated 10 million from this school in 2024, you will look at in that 2024 how much was spent, how much left that school. That is the matching concept. Then matching concept is closely related to the realization concept. In accounting, when we say realization, we are talking about you want to decide whether you have made profit or not. You are trying to decide whether you have made profit or not. So in realization, we say that before you can say you have made profit, you must record all the income that you generated, and you must also record all the expenditure that you incurred. So it is when you have the total, you have cautiously and recorded all the income that you generated, and you critically ensure that you recorded all the expenditure that you made, It is then that you can say that you have either made profit or not. That is what the realization is talking about. Realization says that we cannot say we have made profit when we have not recorded all our income and expenditure. Then we also have another concept which we call the accrual concept. The accrual concept. What is accrual? Accrual comes from the word accrued expenses. Accrual comes from the word accrued expenses. When we talk of accrued expenses, we are saying all the expenses, all the services rendered to that organization which they have not paid for it. They have enjoyed the services, but yet they have not paid for it. It's just like now that if your workers have worked for you, you have not paid them. It is the time they render those services, that is the time you will record it. It is not necessarily when you eventually pay them. Let's say you are owing your salary to your workers in general in November and in December. 2 months, you have not paid them. But you now later in January 2025, you pay them. It is those months that they worked, November and December 2024, it is that amount you will record for 2024. You will not record it that the time that you make payment to them. The time you make payment to them is different from the time they render the service. It is the time they render the service that you are going to record. But you record it that they render the service, but you have not yet paid it. That is why it will be an accrued expenses. It's the same thing. You enjoy NEPA light, but you have not paid. So it is an accrued expenses. Somebody have done maintenance for you, you have not paid. It is an accrued expenses. So it is when the service was rendered, that is when the accountant will record it. It is not when you actually paid for it. Then the next is monetary measure. What we mean by monetary measure is in accounting, anything that cannot be recorded in currency, we cannot, we don't take it in accounting. Anything that cannot be measured, anything that we cannot say, this is the price, we cannot record it. So if you spend money, you must be able to record how much you spent, and that is what concerns the accountant. But the thing that cannot be measured, something like beauty, we cannot say this is how much is attached to it. Something like love, we cannot say this is attached to it. We cannot say things that are emotional, we cannot attach anything, any financial value to them. Because of that, we are not we don't measure them in accounting. So in accounting, it's only what we can reduce to naira and kobo. That is why when you are reading financial statements, you see that it is only it's only naira and kobo that you will see there. You will not see any other thing there because they were recorded in the financial way. Then, in accounting, there must be objectivity. What do we mean by objectivity? Objectivity, the opposite of objectivity is subjectivity. But in accounting, we go for objectivity. Why do we say we must be objective? Objective in accounting means that anything you want to record, there must be an evidence. If you say, I spent so and so amount to buy fuel, you must have evidence. That is why at times when you go to some filling station, you see some company cars, when they are buying fuel, they normally say they need receipt. Because that is the receipt they will give to the accountant in the office, which stand as objective report that they actually bought fuel, and this was the value of the fuel they bought. If you carry out maintenance, you must collect receipt. If you sleep in an hotel, you must collect receipt. If you are on a official assignment, any money you spend, make sure you collect receipt because that is what the accountant will use to enter the record. Because if there is no record, if there is no receipt backing those records, an auditor can come and say that that money you recorded was not actually spent. So in accounting, if you say social amount, this asset was purchased with social amount, let there be a receipt. So what we did not see, we cannot record it in accounting. That is why we are having what we call source document. Anything that is recorded, there is a file where we keep the receipts, where we keep the statement of result, a statement of account, where we keep all the statement, which shows that it is based on what is in the receipt, it is what is in the invoices that made us to record it in the books of account. We also believe in materiality. Materiality is a convention in accounting. That is, in any statement you are providing, there must be material evidence. There must be material evidence. Anything that need to support your figures must be provided. That is, if you say this company, this is the statement of account of this company, you must have evidence to show. And that is what we call material evidence. There must be something to show. Example, if you say you bought a house, there must be evidence to show that you actually bought a house. If you say that, yes, you pay so and so to workers, there must be evidence to show. That is the reason why at times when you meet the company accountant is paying workers, as he's paying, he will tell them to sign for it. He's trying to follow this concept of materiality. That is to have material evidence to show. We also have what we call consistency. Consistency means that in accounting, as a convention, any policy we set, anything we are doing, we don't change it like that in accounting. Accounting is not like any other course that today you say you are doing it this way, tomorrow you say you are doing it this way. It is not done in accounting. In accounting, you must do it the way it ought to be done. And you don't change it like that. Just like example of consistency is accounting policy like depreciation. If you say you are depreciating an asset by 20% every year, that 20%, you will follow it every year, 20% of the value, you take it out. You debit your profit and loss account, so with that 20%. So you must, if on the other hand, you say you are reducing the value of that asset by depreciation of 30%, you must maintain it. Not that today you say 20%, tomorrow you say 10%, and the next time you say it's 30%. It is not done in accounting. Accounting generally flows from consistency. We are consistent in what we are doing. We don't allow maybe changes in technology, changes in the environment to make us to change. So accountants are very consistent in what they are doing. Apart from this depreciation, if we also look at how you do your amortization. If you say this is how you do your amortization, you have to follow it. So the last part of this convention is conservatism. Conservatism. Accountants are known to be conservative. Accountants are known to be conservative. When we say accountants are conservative, yeah, we are not saying that accountants are not dynamic. The technical word conservatism here is that accountants don't rush to recognize profit. No, accountant will not rush to recognize profit. That is one of the major differences between an accountant and a non-accountant. When you are discussing business, a non-accountant will always estimate and tell you that you do this, you make so and so profit this month, next month you make so and so profit. By the end of the year, you made this kind of profit. And accountants are not expected to talk like that. They're not expected to think like that. Accountants will first of all recognize loss, then you start proving that there will be no loss by showing that this is how the income is going to flow, this is how the expenditures will be made, so that at the end of the day there is a profit. So accountants are not in haste to recognize profit. They recognize loss first before they recognize a profit. but non-accountants are always eager to quickly recognize profit. So accountants are conservative in that area. They don't recognize profit on time. Rather, they recognize loss before they recognize profit. Then, apart from those accounting concepts and conventions, we have other theories that have been developed over time, which help us to understand accounting, which help us to know how organizations use accounting information. One of those accounting theory is what we call the rational choice theory in accounting. The rational choice theory. By the way that construct is, they say rational choice theory. Rational means it is expected that you behave in an economic people generally have preferences for what they will, what the organization will potentially benefit, what that transaction will be of benefit to them. So rational choice theory holds that people have preferences among the options that are accessible after weighing potential benefits against the cost. So before, when people are taking uh, decisions, what they normally do is that they prefer